Now we are starting a new lesson called Strategy Build. In this lesson, we are going to learn how to create a clear trading plan before taking a trade. This is very important because many beginner traders enter trades based on emotion. They see a candle moving fast, they feel fear of missing out, and they jump in without a plan. That is not a strategy. A real trading strategy gives us rules. It tells us when to enter, when not to enter, where to place the stop loss, where to take profit, and how much risk we are willing to take. The main point on this slide is a strategy removes guessing and gives the trader rules to follow. This does not mean every trade will win. No strategy wins all the time. But a strategy helps us stay consistent. It helps us make decisions based on rules instead of fear, greed, or excitement. Before we take any trade, we should know, why am I entering? Where am I wrong? Where is my target? How much am I risking? Does this trade match my strategy? If we cannot answer those questions, we should not take the trade. A good trader does not just look for a signal. A good trader builds a plan, follows the plan, and manages risk. Now, let's talk about the lesson goal for strategy building. By the end of this lesson, students should be able to explain every part of a trading plan. A trading strategy is not just about finding a buy signal or a sell signal. A real strategy has clear rules. First, we need to understand the market condition. Is the market trending up? Is it trending down? Is it moving sideways? Is volatility high or low? Next, we need to define the setup. A setup means the conditions we want to see before we even think about entering a trade. For example, price may need to be above a moving average, near support, or showing strong momentum. Then we need to define the entry. The entry tells us exactly when we are allowed to take the trade. We do not enter randomly. We wait for the rule to trigger. After that, we need a stop loss. The stop loss tells us where we are wrong. This protects us from letting one bad trade become a big loss. Then we need a take profit plan. The take profit tells us where we want to exit if the trade works in our favor. We also need trade management rules. This means we need to know what to do after we are already in the trade. Do we move the stop loss? Do we take partial profit? Do we exit if momentum weakens? Finally, we need no trade rules. No trade rules are very important. They tell us when to stay out of the market. Sometimes the best trade is no trade. The main goal is not to trade more. The goal is to trade better. A good strategy helps us become patient, disciplined, and consistent. Now, let's define what a trading strategy is. A trading strategy is a written plan that tells you exactly what to do before, during, and after a trade. This is important because trading without a strategy usually leads to emotional decisions. A trader without a plan may enter because of excitement, fear of missing out, or because price is moving fast. But a trader with a strategy has rules. A complete strategy should define several things. First, it tells us when to enter. This means we know the exact condition that must happen before we take a trade. Second, it tells us when not to enter. This is just as important as the entry rule. Sometimes the market is too choppy, too volatile, or too unclear. In those situations, the strategy should tell us to stay out. Third, it tells us where to place the stop loss. The stop loss is the point where we admit the trade idea is wrong. It protects our account from large losses. Fourth, it tells us where to take profit. Before entering, we should know where we expect the trade to go and where we plan to exit if the trade works. Fifth, it tells us how much to risk. Every trade should have controlled risk. We should never risk too much on one trade. Finally, it tells us when to exit. Sometimes we exit at the target. Sometimes we exit at the stop loss. Sometimes we exit because the setup is no longer valid. The main lesson is this. A professional trader follows rules, not excitement. Excitement can make traders chase trades. Rules help traders stay patient, disciplined, and consistent. Now, let's talk about why you need a strategy. Without a strategy, traders often make emotional decisions. This is one of the biggest problems in trading. When traders do not have a plan, they may react to every candle, every price move, and every feeling. They may enter because they are excited. They may exit because they are scared. They may chase a trade because they do not want to miss out. That is not disciplined trading. A strategy gives us structure. Let's look at some common mistakes traders make when they do not have a plan. The first mistake is chasing trades. This happens when price already moved and the trader enters late because they are afraid of missing the move. The second mistake is entering too late. By the time the trader enters, the best part of the move may already be gone. This can create poor risk and reward. The third mistake is moving stop losses. A trader may set a stop loss, but when price gets close to it, they move the stop farther away. This can turn a small loss into a big loss. The fourth mistake is holding losers too long. Instead of accepting the loss, the trader hopes the trade will come back. Hope is not a strategy. The fifth mistake is exiting winners too early. Sometimes traders get scared and take profit too quickly, even when the trade is still working. The sixth mistake is overtrading. This means taking too many trades, often because of boredom, frustration, or trying to make back losses. The main lesson is this: a strategy helps create discipline and consistency. It gives the trader rules to follow, so decisions are not based on emotion. A good strategy does not remove risk, but it helps control risk. And in trading, controlling risk is one of the most important skills we can learn. Now we are starting step 1. Identify market condition. Before taking any trade, the first thing we must understand is the market environment. This means we do not just look for a buy or sell signal right away. We first ask, what type of market are we trading in? The market can be in different conditions. It can be trending up, where buyers are in control, and prices making higher highs and higher lows. It can be trending down, where sellers are in control, and prices making lower highs and lower lows. It can be sideways or choppy, where price is moving back and forth without a clear direction. It can be a high volatility market, where candles are large and price is moving fast. It can be a low volatility market, where price is moving slowly and the candles are smaller. It can also be a news-driven market, where price may move suddenly because of earnings, economic news, interest rate decisions, or major headlines. This step is important because not every strategy works in every market condition. For example, a breakout strategy may work well in a trending market, but it may fail in a choppy market. In a choppy market, price may break above a level and then quickly reverse. That can trap traders who enter too early. So before entering a trade, always ask, is the market trending? Is it choppy? Is volatility high or low? Is there news affecting the move? The main lesson is this: a good trader does not force the same strategy in every market. A good trader first identifies the market condition, then chooses the right strategy for that environment. Now we are on step 2. Define the setup. A setup is the situation we are waiting for before entering a trade. This is very important because a setup is not the same as an entry. The setup tells us what we want to see before the trade even starts. For example, one common setup is a pullback to support. This means price is in an uptrend, then pulls back to an area where buyers may step in again. Another setup is a breakout above resistance. This means price has been struggling to get above a level, and now it breaks through that level with strength. Another setup is a VWAP reclaim. This means price was below VWAP, then moves back above VWAP. For intraday traders, this may show buyers are taking back control. Another setup is a moving average bounce. This means price pulls back to a moving average, holds it, and then starts moving again in the direction of the trend. Another setup is a trendline breakout. This happens when price breaks above or below a trend line, showing that the previous structure may be changing. We can also have a bull flag or a bear flag. A bull flag usually happens after a strong move up, followed by a small pullback. A bear flag happens after a strong move down, followed by a small bounce. Another setup is a squeeze breakout. This means volatility has compressed, and now price may be preparing for a larger move. The main lesson is this: the setup tells us what we are looking for before the trade starts. A good trader does not enter randomly. A good trader waits for the setup first, then waits for the entry trigger. Now we are on step 3, entry trigger. The entry trigger tells us the exact moment to act. This is important because the setup only prepares us. The setup tells us what we are watching for, but the trigger tells us when we are allowed to enter. For example, price may be near resistance. That is the setup. But we do not enter just because price is near resistance. We wait for a trigger, such as the candle future closing above resistance, price breaking the previous candle high, or volume confirming the breakout. Let's look at some common entry triggers. One trigger is when a candle closes above resistance. This can show that buyers are strong enough to push price through an important level. Another trigger is when price breaks the previous candle high. This can show short-term buying strength. Another trigger is when price reclaims VWAP. For intraday traders, this may show buyers are taking back control. Another trigger is when a bullish engulfing candle forms. This can show buyers are stepping in with strength. Another trigger is a MSCID crossover. This can show momentum may be shifting. Another trigger is when volume confirms the breakout. A breakout with strong volume is usually more meaningful than a breakout with weak volume. The main lesson is this: the setup prepares you. The trigger tells you when to enter. A good trader does not enter early just because a setup looks interesting. A good trader waits for confirmation, then acts according to the plan. Now we are on step 4, stop loss. A stop loss is the place where we exit the trade if the trade idea is wrong. This is one of the most important parts of a trading strategy because every trade has risk. Before we enter a trade, we must already know where we will get out if the market moves against us. A stop loss is not there to punish us. It is there to protect us. Let's look at some common stop loss locations. For a long trade, a stop loss may go below support. If support breaks, the reason for the trade may no longer be valid. For a short trade, a stop loss may go above resistance. If price breaks above resistance, sellers may no longer be in control. Another stop location is below the previous candle low. This can be useful for short-term trades because it gives us a clear level where the recent candle structure is broken. Some traders also place stops below VWAP. For intraday trading, if price loses VWAP after a long setup, buyers may be losing control. Another stop location is below a moving average. If price breaks below the moving average that was supporting the trend, the trade idea may be weakening. Some traders also use an ATR-based volatility stop. This means the stop loss is based on how much the market normally moves. If volatility is high, the stop may need more room. If volatility is low, the stop may be tighter. The main lesson is this: place the stop where the trade idea is invalid, not where emotions get uncomfortable. Many traders move their stop because they do not want to take a loss. That is dangerous. If the trade idea is wrong, we accept the small loss and protect our account. A professional trader does not trade without a stop loss plan. Now we are on step 5, take profit. The take profit is the place where we plan to exit the trade with gains. This is important because many traders enter a trade without knowing where they want to get out. Then, once they are in profit, emotions take over. They may get scared and exit too early, or they may get greedy and hold too long until the profit disappears. A good strategy defines the take profit before the trade starts. There are different ways to choose a profit target. One way is using the previous high or previous low. For a long trade, the previous high can be a possible target because price may react there. For a short trade, the previous low can be a possible target. Another way is using support or resistance. If you are buying, resistance may be an area to take profit. If you are shorting, support may be an area to take profit. Another method is using a risk-to-reward ratio. This means we compare how much we are risking to how much we are trying to make. For example, if we enter at $100, place our stop loss at $98, and set our target at $104, we are risking $2 to try to make $4. That is a 1-2 risk-to-reward trade. Another way is using an ATR target. ATR helps us understand how much price usually moves, so we can set a more realistic target based on normal volatility. Some traders use a trailing stop. A trailing stop allows the trader to stay in the trade while it is working, but exit if price reverses by a certain amount. Another method is using partial profit levels. This means the trader may take some profit at the first target and leave the rest of the position open for a bigger move. The main lesson is this: do not enter a trade unless you know where you plan to take profit. A professional trader plans the exit before entering the trade. Now we are on step 6, trade management. Trade management is what we do after the trade is open. A lot of traders focus only on the entry, but the entry is only one part of the trade. After the trade is open, we need rules for how to manage it. The first rule is moving the stop loss to break even after the trade moves in our favor. Break even means we move the stop loss to our entry price, so if the trade comes back, we do not lose money on that trade. But we should not move the stop too early. If we move it too quickly, normal price movement may stop us out before the trade has enough room to work. The second rule is taking partial profit at the first target. This means we can close part of the position and lock in some profit, while still leaving part of the trade open in case price continues moving. The third rule is trailing the stop behind higher lows. In an uptrend, if price keeps making higher lows, we can move the stop under those higher lows. This allows us to protect profit while still giving the trade room to continue. For a short trade, we can trail the stop behind lower highs. Another rule is to exit if momentum fades. If the trade was moving strongly, but momentum starts weakening, volume drops, or candles become smaller, that may be a sign the move is slowing down. One of the most important rules is do not move the stop farther away. Moving the stop farther away usually means the trader is emotional and does not want to accept the loss. That can turn a small planned loss into a much bigger loss. The main lesson is this: managing the trade is just as important as entering the trade. A professional trader does not just plan the entry, a professional trader also plans what to do after the trade is open. Now we are on step 7, position sizing. Position sizing decides how many shares or contracts we should trade. This is one of the most important parts of risk management. Many beginners choose position size based on confidence. They may think, this trade looks very good, so I will take a bigger position. That is dangerous. A professional trader chooses position size based on risk. Let's look at the example on the slide. The maximum risk is $100. The entry price is $50. The stop loss is $48. That means the risk per share is $2. So we take the total risk, which is $100, and divide it by the risk per share, which is $2. $100 divided by $2 equals 50 shares. So in this example, the trader can buy 50 shares and risk about $100 if the stop loss is hit. This is powerful because it keeps risk controlled. The trader is not guessing position size, the trader is using a rule. The formula is position size equals maximum risk / risk per share. The main lesson is this: position size should be based on risk, not confidence. Even if a trade looks very strong, we should still control the risk. Good traders protect their account first. Profit comes after risk is controlled. Now we are on step 8, no trade rules. A good strategy does not only tell us when to trade, a good strategy also tells us when to stay out. This is very important because many losses come from trading in the wrong conditions. Sometimes the best decision is not to enter at all. Let's look at some common no-trade rules. The first rule is no trade during major news. Major news can move the market very fast. Price can spike up and down quickly, and stop losses can get hit before the trader has time to react. The second rule is no trade after the daily loss limit is reached. Every trader should have a daily loss limit. Once that limit is reached, trading should stop for the day. This prevents revenge trading and protects the account. The third rule is no trade when emotional. If a trader is angry, frustrated, scared, or trying to make back losses, they are more likely to make bad decisions. The fourth rule is no trade in choppy price action. Choppy markets can create many false signals. Price may break up, then reverse down, then break down, then reverse up. This can trap traders. The fifth rule is no trade if volume is too low. Low volume means there may not be enough participation behind the move. A breakout with low volume may fail more easily. The sixth rule is no trade if risk to reward is poor. If the possible profit is too small compared to the risk, the trade may not be worth taking. The main lesson is this: sometimes the best trade is no trade. A professional trader does not need to trade all the time. A professional trader waits for the right conditions, protects capital, and only takes trades that match the plan. Now, let's look at an example, a pullback strategy. This is a simple strategy where we are looking to buy a stock that is already in an uptrend. First, we identify the market condition. In this example, the stock is in an uptrend. That means price is making higher highs and higher lows, or price is staying above an important moving average. Next, we define the setup. The setup is that price pulls back to support or to a rising moving average. This is important because we do not want to chase the stock after it has already moved too far. We want to wait for price to pull back to an area where buyers may step in again. Now we define the entry. The entry happens when a bullish candle closes above the prior candle high. This gives us confirmation that buyers may be coming back into the trade. Next is the stop loss. The stop loss can go below support or below the pullback low. That means if price breaks below that area, the trade idea may no longer be valid. Now we define the take profit. The profit target can be the previous high, or we can use a 1 risk to reward ratio. For example, if we risk $1, we want the potential reward to be at least $2. Finally, we define the no trade rule. We avoid the trade during major news or when volume is weak. Weak volume can mean there is not enough participation behind the move. The main lesson is this: a pullback strategy is not just buying because price went down. We are looking for an uptrend, a pullback to a key area, a bullish entry trigger, a clear stop loss, a realistic target, and a reason to stay out if conditions are not good. That is how we turn an idea into a complete trading strategy. Now, let's finish this section with the strategy checklist. Before using any trading strategy, we should be able to answer these questions clearly. The first question is, what market condition is best for this strategy? Some strategies work better in trending markets, some work better near support and resistance, some work better after volatility compression. We need to know the right environment. The second question is, what is the exact setup and entry trigger? The setup tells us what we are waiting for. The entry trigger tells us the exact moment we are allowed to take the trade. If we cannot explain the setup and trigger clearly, the strategy is not ready. The third question is, where are the stop loss and take profit? Before entering, we must know where we are wrong and where we plan to take profit. The fourth question is, what is the risk to reward? We need to know whether the possible reward is worth the risk. The fifth question is, how much money is at risk? This is position sizing. We should know the dollar risk before taking the trade. The sixth question is, what are the no trade rules? A good strategy tells us when to trade, but it also tells us when to stay out. The final question is, has this strategy been tested? Before risking real money, we should test the strategy. We can review past charts, paper trade, or backtest the rules. The main lesson is this: a strategy is not just an idea. A strategy is a complete plan with rules for market condition, setup, entry, stop loss, take profit, risk, no trade conditions, and testing. If we can answer every question on this checklist, we are much more prepared to trade with discipline. Now, let's finish with a simple teaching summary. A strategy is a written trading plan. It tells us exactly what we are waiting for, when to act, and how to manage the trade after we enter. A complete strategy defines the market condition, the setup, the entry, the stop loss, the target, the position size, and the risk. The setup tells us what to wait for. The trigger tells us when to act. This is important because we do not want to enter randomly. We want to wait until the strategy rules are met. No trade rules are also very important because they protect us from bad conditions. Sometimes the best decision is to stay out of the market. A professional trader does not enter because of excitement, fear, or guessing. A professional trader enters because the strategy rules are met. The main lesson is this: good trading is not about taking more trades. Good trading is about taking better trades with a clear plan and controlled risk.